Hello and welcome to Lesson 9 for the Unit of Finance in HSC Business Studies. In this lesson we're going to continue to look at financial ratios. Just to recap, we use financial ratios and the information that they give us to give us key financial relationships and information. They really tell us how well a business is doing. It allows us to gauge whether the business has solvency, liquidity, is doing things efficiently, and has profitability. Today, we're going to look at liquidity ratios. Now remember, liquidity is the ability to pay short-term debts, so they're current liabilities. It's measured in a ratio called the current ratio. You need to know this ratio. You will be given the formula for the ratio in your examinations. However, you need to know how to retrieve the information for the ratio. It's calculated using the balance sheet only. So you need to understand the concept of the balance sheet, and you need to understand the different elements of the balance sheet. The current ratio equals current assets divided by current liabilities. So current assets over current liabilities. You need to make sure you write this down, and we will practice this in class. So this is where we get the information from. In this particular case, on this statement and balance sheet, we can see that the total current assets is $3,547.70. The total current liabilities down here is $4,214.90. If we make that calculation, it calculates to 0.84. That means for every $1 of liabilities, this company, Amcor, has 84 cents of current assets. If we're doing analysis over a couple of different years, and the previous year's ratio was 0.79, this would suggest that they're more liquid, that they're able to pay those short-term liabilities in a better way than they could the previous year. It's really important though to know what this means. It means for every $1 of liabilities, the company only has 84 cents of assets that they can convert to cash. That's not the best ratio. That means they have more debts than they have assets. And we'll talk about how they can manage that a little bit later. The next ratio we're going to look at, which we touched on in lesson 8, is the solvency ratio. Solvency means the long-term stability of the business. Can the business maintain its long-term debt and financing? It's measured in a ratio called the gearing ratio, and the gearing ratio measures the percentage of long-term debt which is financed by equity. So you see the calculation, gearing ratio equals the total liabilities, so the total debt, divided by the owner's equity times 100, because we want to get a percentage. You need to write this one down. So let's look where we get the information from. Once again, the information comes from the balance sheet. It comes from this area here, total liabilities, which is $7,186.30. And the total equity comes from the equity section, which is $4,123.90. If you make that calculation, it calculates to 1.74. Times that by 100 is 174%. Basically, this means that for every $1 of equity, the company has $1.74 of debt or liabilities. This is a high gearing ratio. It means that they have quite a lot of debt and not enough investment into the business to cover that debt into the long term. The gearing ratio is usually around 60%. That's the perfect ideal ratio. If it's too high, so the example from Amcor, It's unlikely that the business will remain solvent, which means that the business will not have long-term ability to meet its debts. It hasn't got enough invested money into the business, and it is accumulating higher debts. If the gearing ratio is too low, around about 20 or 30%, that means that it has too much equity, and the equity is just sitting there and not being used effectively. It means that the business is not using the funds that it has available, invested into the business, to grow the business. That's the end of this lesson. I hope you understood it, and we'll move on now to profitability ratios.